Hello, I'm Peter Herbert. Welcome to the latest in our series of short CPD webinars looking at topical aspects of accounting, auditing, and company law. This month, we're going to focus on the revised LLP Sword that takes effect for periods commencing 1 Jan 2022. The Sword's been around since about 2001. It's changed quite a bit in that time. But that being said, firms that we work with don't generally act for lots of LLPs. There aren't so many of them out there. When I last checked, there were about 60,000 LLPs in total in the UK, compared to about 4.7 million companies, with 810,000 new company formations in 2021 alone. But there are some out there. Accounts do need to be prepared and audits done. And with that in mind, we're going to run through the implication of the revised LLP SORP. We'll start off with an overview of the new SORP and then talk about the most interesting bit, which is the bit that deals with members' interests, with some examples. We'll finish off with another aspect which is not really changing with the new LLP SORP as such, but we do get asked quite a few questions about, which is disclosure notes within the notes of the accounts of small LLPs prepared in accordance with Section 1A of FRS 102. So a couple of questions on that to finish off this short session. Okay, so here's the LLP SORP as revised, issued by the CCAB, the Consultative Committee of Accountancy Bodies, and that's where you can get a download of the SORP in its entirety. Issued December 21 and effective for periods commencing 1 Jan 22. Now, the interesting bit, I think, is the bit which clarifies whether profits are distributed on an automatic or discretionary basis. We'll cover that in a bit more detail in the next section. There's also a bit in there around the clarification about the classification of payments to members in the statement of cash flows and whether those payments to members should be treated as financing cash flows or indeed treated as operating cash flows. That's not massively contentious, but is quite helpful. There's also reference made to the company's directors' report and limited liability partnerships, Energy and Carbon Report Regulations 2018. Now, as you may recall, large LLPs, like large companies, have to comply with this streamlined energy and carbon reporting regulations regime. The previous version of the LLP SORP didn't deal with that. The new version does. Now, the disclosure requirements in the annual report are the same as they would be for any other company, which is in scope for SECA. I guess the key thing to bear in mind is that in a company, the relevant disclosures would appear within the director's report. You don't have such a report in the annual report of an LLP, and therefore the SECA report would either be embedded within the member's report or would appear as a separate document. Many firms that we work with that act for LLPs, those LLPs do tend to be small or micro. The SECA regime only applies to large companies and large LLPs. And for that reason, for many people, the SECA aspect of the revision will be very much out of scope. Right, let's move on to the members' interests classification bit. As I say, the new SORP clarifies whether profits are distributed on an automatic or discretionary basis. When an LLP makes profits, the question is, do the members have an unequivocal entitlement to those profits? If they do, they are charged to the P&L as members' remuneration charges and expense, and credited to loans due to members within the LLP balance sheet. If the members don't have an unequivocal entitlement, the profits drop to the bottom of the P&L, then get transferred across into equity, and from there move to liabilities when the decision to make a distribution has been made subsequently, and from there get paid away. Now, there's no change in the rules and how this works, but it's been a big area of confusion and debate over the years. And what the new LLP SORP has done, it's clarified the way that the thought process should work and put some examples in to make clear how you would work through the process and decide whether there was indeed an automatic entitlement or whether the division of profits was made subsequently, and therefore in the year the profits were made, whether they were treated quite simply as equity within the bottom half of the LLP balance sheet. So there's our P&L, and if you do have some or all the profits to which the members have an unequivocal entitlement, we're going to debit members' remuneration charges and expense. If all the distributions are made on a discretionary basis subsequent to the year end, then members' remuneration charges and expense will not be a P&L caption for the LLP in question. And then moving on to the balance sheet, amounts the members are unequivocally entitled to appear as loans and other debts due to members. We tend to refer to that as the J heading within the bottom half of the LLP balance sheet. Any amounts which the members do not have an unequivocal entitlement to, e.g. profits not yet formally divided between the members, that's treated as equity or members' other interests in the bottom half of the LLP balance sheet, and we sometimes refer to that as the K heading within that balance sheet. Key thing to bear in mind in relation to LLPs as opposed to, I suppose, companies, is that all the amounts that are owed back to the members are treated as bottom half of balance sheet amounts. So if an amount is unequivocally payable to the member, it appears as J in the top half of the bottom half of the LLP balance sheet. Any other profits, any other amounts ultimately payable to members, they appear as equity in the bottom half of the bottom half of the LLP balance sheet. That's the way classification works, always has done, based on LLP regulation and the LLP Sword. Now, as I say, there's no change to the actual rule, but what the new SORP does, it talks about in terms of the whole aspect of clarifying how the accounting should work in relation to members' profit share, as it were, 3 key steps. So what happens first is that the profits are allocated to the members without them having a right to receive those profits. At that particular point in time, there's no liability as such. And that's always been the case. We might have a situation where maybe 3 of us are members of an LLP. We've got a profit share agreement that says we're entitled to 1/3 each, but it's not clear at the point that that profit share agreement is put together exactly what figure we're entitled to 1/3 each of. So that loose profit share agreement is an allocation, but does not give rise to a division in that moment. Division is the mechanism by which profits become a debt due to members. And as we saw with our P&L a moment ago, it could well be that based on the members' agreements, that division is automatic. There's an automatic entitlement, which gives rise to the profits being charged to the P&L as members' remuneration charges and expense. Either way, subsequent to this first 2 stages of the process, we then have the distribution whereby the actual cash is paid away. We debit loans, credit bank, and the payments made to the members in that particular sense. Now, there's a number of examples in the SORP which help to clarify the way this 3-stage process works. Just to give you a couple to kick things off here, what they talk about in the SORP is that it could well be that profits are allocated without having been divided. It could, for example, be that we got an allocation of profits to inform the individual personal tax returns of the members, and those profits that have been allocated to the members will indeed appear on their personal tax returns, but in the years in which those allocations have been made, there's no division as such. So you can have allocation in one year and division in the next. It could be that profits have been divided without having been allocated. So it may be that we know that £100,000 of profits automatically will get distributed to the members. There's an automatic entitlement to the members to that £100,000 of profit. There will therefore be, in respect of those profits, a charge to the P&L and a credit to loans due to members. But it might well be that we need to wait until post-year end, when perhaps annual appraisals are done, to work out which individual member will get which portion of that £100,000. We therefore got the division in that situation without having the allocation. It could be, thirdly, the profits have been allocated and divided. They've therefore been credited to loans due to members without having been distributed during the period. But the 3-stage approach is key. And it's a quite slightly different way of framing the process, which has come into the new SORP. It does, I think, make things clearer as to how it would work case by case in determining the entries in the year for the LLP you're working within or acting for. Right, let's finish off this section then with some examples, all very much in the new SORP. So the first one here is, can an in-year division be deemed to have taken place if it depends on the profit in the audited accounts? And the revised SORP makes clear that absolutely it can. So if we know that the profits per the P&L in the audited accounts will, in part or in their totality, be divided between the members based on the members' agreement, and that is automatic, the fact that at the year-end balance sheet date, the profits have not yet been calculated definitively because the audit's not yet been done, that's kind of splitting hairs. So in that year's accounts, treat that element of profit as a debit to the P&L and a credit as loans due to members in the bottom half of the LLP balance sheet. Number two, where an LLP agreement is silent as to the mechanism by which the profits of the LLP could become a debt due to members, could division be implied? Now, really interestingly here, the answer is possibly. I must admit, I have over many years said that in the absence of a members agreement that's formal, it's very difficult to argue that an unequivocal entitlement to profits exists, and therefore the P&L should be debited and loans due to members should be credited in the bottom half of the LLP balance sheet. However, paragraph 31E of the SORP suggests that that may not be the case. Okay, so where an LLP agreement is silent as to the mechanism by which the profits of the LLP become a debt due to members, all facts and circumstances should be considered. The profits are only converted into a debt due to members when the profits have been divided, and it's a matter of construction of the members' agreements whether this happens on an automatic or discretionary basis. LLP agreements may take a variety of forms. As a matter of law, they need not be in writing and may be amended by conduct. So I wonder whether, off the back of that, we may have situations going forward whereby more profits are deemed to have been divided automatically based on the conduct, and that pushes more profits towards J in the bottom half of the LLP balance sheet and less towards K. Interesting angle there, not one I've given consideration to before, but certainly food for thought there in paragraph 31E of the revised SORP. The default position has been to divide all the profits, and the LLP has done that for the last 10 years. Does that not create a constructive obligation? Again, the constructive obligation is a concept, isn't it? In section 21 of FRS 102, when we're talking about provisions for liabilities. And we say that a constructive obligation can be based on a declaration of intent or a past precedent. Now, my take is that in terms of amounts due to members, and whether we treat that as debt or equity, that aspect of constructive obligation does not really work in quite the same way. I think when it comes to the debt equity split in the balance sheet of any entity, LLP company or any other, we do need a legal obligation to make a payment. However, because we're now saying that the obligation can be implied as well as being explicit, one wonders whether some LLPs, where payments being made over the last 10 years, every single year, might not imply an agreement exists, and might that again not push profits more towards being debt in the bottom half of the LLP balance sheet and less towards being equity. So I think the answer there is technically no to number 3, but put 2 and 3 together, we may have more situations going forward where amounts are deemed to be debt than equity than perhaps was the case pre this revision to the LLP SORP. Lots of food for thought there for accountants, and lots of food for thought, of course, for auditors as well. Okay, so that's just a few thoughts on those scenarios. Again, do have a look at the SORP, do download it. There are more examples besides, all interesting stuff. It's a very contentious aspect, I would say, of accounting generally. So if you do act for LLPs, even for an accounting period beginning before 1 Jan 22, it is well worth a look. Do have a look there via the CCAB website. Let's finish off with those questions about small LLPs. We've had a couple recently along these lines. Does a small LLP with an overdrawn member's loan account need to disclose this in the notes to the financial statements? Well, categorically, no. The question, I think, cropped up because we had a firm that had got a client with the situation going on. And the question I got asked was around, given that in a company, if we had an overdrawn director's loan account, that would need to be disclosed in the accounts of any company, micro, small, medium, or large, based on section 413 of Companies Act 2006, would that not apply in the same way for an LLP? Section 413 does not apply to LLPs because they don't have directors. There's no specific requirement to disclose that in the notes. You could, of course, disclose it if you felt it was appropriate to inform a true and fair view. But the bottom line with that one is that the answer would categorically be no. And the second question, does a small LLP need to produce a statement of changes in equity? And does it need to be filed at Companies House? Well, technically, no. Technically, no. What we talk about in the LLP SORP is that they encourage LLPs with equity to include a statement of changes in equity in their members' accounts. there's no obligation, but many do. But what's really clear in my mind is that when you do include that statement of change in equity, and it's in there to inform a true and fair view, and it's a primary statement, as will be the case with a similar size company, it would not typically get filed at Companies House. Discussions between the Institute and Companies House years ago confirmed that where in a 1A world, extra primary statements are included in the statutory accounts to inform a true and fair view, but not required by law, when it comes to filing, those additional primary statements can indeed be filleted out. Now, of course, we are moving towards a world in 2023 where filleting as a concept will cease to exist for small and macro companies. But at the time of recording this in November 2022, the answer is no to the preparation, no to the filing, and that's the way, again, I would deal with that one. But again, recommended by the SORB, but no obligation, and that's why that one we're categorically saying no as the answer to. Okay, so there we are. That's this month's little CPD session done. We did an overview of the LLP SORB as it's changing. We talked about some of the members' interest issues and talked about some of the disclosure issues in small LLPs. Do have a look at the SORB itself, which, as I say, you can access through the CCAB website. For more information from us about this session, do drop us an email, inquiries@insight-training.co.uk. And for our full programme events this autumn, go onto our website at www.insight-training.co.uk, and all the information that you need will be there. Thanks for watching. Great to speak to you all. Speak to you all soon. Goodbye.